Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RCAT Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's unpack this. We're jumping straight into RCAT Holdings, a name that's right at the intersection of defense tech, drone warfare, and autonomous systems.
And our goal today is to give you a really complete but concise understanding of where this company is headed. We've pulled out the critical points on their explosive financial growth.
Right.
And their specific tech advantages, and maybe most importantly, the make-or-break catalysts coming up in the next few months.
And the reason we're even talking about them is purely based on performance.
Yeah.
I mean, you're looking at a small-cap defense player that just reported, what was it, a 646% year-over-year revenue growth.
Yeah, it's an incredible number.
That's not typical,
Right.
even in the fastest-growing sectors. So our job is to figure out what drove that and, crucially, if that kind of velocity is even sustainable.
Exactly. And you have to balance that top-line excitement with a bit of healthy skepticism about, execution and profitability. It gives you a real-time snapshot of what it takes for a U.S. manufacturer to scale up production this fast.
Okay, so let's dive into those Q3 2025 numbers. They're really the foundation for this whole story. Revenue came in at $9.65 million.
Mm-hmm.
And while that 646% year-over-year jump is the headline, the metric that really caught my eye was the 200% sequential quarterly growth.
Yes, from Q2 to Q3.
That's the one that shows a real scaling ability.
When you see figures like that, it tells you the company's moved past, just prototyping and early adoption. It signals an inflection point.
Right.
Where their product development is finally turning into actual scalable production. They clearly solved a major bottleneck somewhere between Q2 and Q3 that let them, triple their output.
And what they're predicting next is, it's less of an acceleration and more of a complete transformation.
This is where the guidance gets really aggressive. Management is aiming for Q4 revenue to hit a massive range of $20 to $22 million.
Wow. So double Q3 again.
Exactly. If they pull that off, the full fiscal year for 2025 would land somewhere between, say, 34.5 and 37.5 million.
Doubling your revenue sequentially twice in a row, that suggests they're moving into a completely different operational league. But to hit $22 million in Q4, that's not just about signing more deals, right? What has to happen operationally in just 3 months?
It requires absolute mastery of their supply chain, full utilization of their manufacturing capacity. You need stable costs, zero hiccups in getting components, especially with those mandates for non-Chinese parts for Blue UAS.
Okay.
It's an immense logistics puzzle.
And there's a trade-off here, isn't there? We saw the Q3 EPS was a miss at negative 16 cents. That tells me they're burning cash pretty aggressively to chase this growth.
Absolutely. That negative EPS is the price tag. They funneled $6 million into R&D just in Q3.
$6 million in one quarter.
Yeah, which is a 66% increase from the quarter before. They are actively trading short-term paper losses for long-term production capacity and technological leadership. It's all about locking in that first-mover advantage.
So the rocket fuel for the revenue is that intense investment. But where does the investment actually go? What kind of competitive moat are they building? Why is demand accelerating for them?
Okay, so the crucial factor here is regulatory compliance. It's all about trust in the defense world. We have to talk about the Blue UAS certification.
Right, break that down for us.
Yeah, so for you, this is way more than just a simple stamp of approval. It's a really stringent process from the Department of Defense. It requires specific security controls, rigorous testing, and critically proving that the drone and all its components are sourced entirely outside of certain adversarial nations.
Particularly China.
Particularly China. So it's basically a government-mandated choke point.
So by having this certification, they are automatically on a short list for contracts that, 95% of drone makers globally just can't even apply for?
Exactly. It creates a massive, immediate barrier to entry. They become a vetted, trusted supplier right out of the gate. And that credential, that Blue UAS stamp, it also opens up global defense contracts, especially across NATO markets.
Okay, but I have to ask, does relying so heavily on this U.S. certification maybe limit their sales in other international markets? Is that a risk?
That's a great question. And While it does narrow their immediate market to those highly regulated environments, that is precisely where the highest margin and largest contracts are. They're choosing exclusivity over, let's say, market breadth.
And they're not just leaning on the regulations. That huge R&D spend is going into next-gen systems.
Yes, you can see the innovation in products like the Black Widow and the FAing drone systems. And what makes them different isn't just the hardware, it's the deep integration of AI and real autonomous capabilities.
Right.
Defense procurement is shifting away from piloted systems to smart, deployable, autonomous units, and RedCat is right at the forefront of that shift.
So that combination of certified status and constant innovation, that's what creates these high switching costs for their customers. Once a military branch invests time and training into the FA&G system, ripping it out for a rival solution becomes incredibly expensive and complex.
It creates long-term stickiness. Their relationships with U.S. and international defense organizations, they validate the tech and give them that critical first-mover edge.
Okay, before we get too swept up in the growth story, let's pivot to the financials, the resilience. Explosive growth can sometimes mask balance sheet issues.
It can, but the balance sheet is actually the major protective factor here. RedCat closed Q3 2025 with cash and receivables of $212.5 million.
That is a huge amount of liquidity for a small-cap firm. It means they've basically taken the governor off their expansion plans.
Yep.
They're not worried about debt or needing to raise emergency capital.
Exactly. Low leverage, huge cash reserve. It's what lets them self-fund this massive scaling effort and crucially weather any temporary procurement delays. Plus, it means they can avoid dilutive capital raises. They don't have to issue more shares.
That's a huge protective factor. But let's get to the immediate pain point, the margins. Q3 gross profit was only, $638,000? That's a 7% gross margin.
Yeah, it's painfully low.
That's very low, even for a high-growth manufacturer. The cash is great, but isn't that just a huge war chest sitting there while they're running on such thin margins?
It raises the big question. Can they sustain that low margin while waiting for the major contracts to really kick in? The cash is for survival, but the margins are for long-term profitability. And management is guiding for a rapid, almost miraculous improvement. They're targeting 10% in Q4 and aiming for 20% by the end of 2026.
Getting from 7% to 20% in 5 quarters is a massive undertaking. I mean, how do they plan to do that?
It all relies on one thing, achieving operational leverage. So for you listening, that just means as their production volume scales up to meet that massive Q4 guidance, all the fixed costs, factory rent, machinery, salaries, get spread across way more units.
Which drops the per-unit cost.
Drastically. They're moving from sort of bespoke assembly to high-volume line production. It's the only way to hit that 20% goal.
So the risk is purely in the execution. If they miss that $20 million Q4 target, the whole cost structure doesn't stabilize, and those margin promises just kind of evaporate.
That's the internal risk. Then there are the external ones. The primary one is just the lumpiness of sales in this sector.
Right, government contracts.
Exactly. They're large, they're concentrated, they're tied to specific budget cycles. So you might have a huge Q4 followed by a really quiet Q1 if the next big contract is delayed. Investors have to be ready for that.
That volatility makes the timing of future announcements just absolutely critical. So let's shift to that. What are the key catalysts you should be watching over the next 3 to 6 months?
Okay, the most immediate one is the Q4 earnings report. We expect that around mid-January 2026. This is the moment of truth.
Did they hit the $20 to $22 million target?
That's question one. And question two, just as important. Did the gross margin start moving towards that 10% goal? Any surprise here, positive or negative, will move the market.
And we know defense contract news often clusters around the end of the year with U.S. and NATO budget cycles.
Which connects directly to the biggest long-term catalyst here, the one that's driving all the speculation. The entire industry is focused on the Short-Range Reconnaissance Tranche 2, or SRR-T2 DoD program.
Okay, let's spend a minute on this. What exactly is SRR-T2, and why is it such a massive potential win?
It's a huge effort by the Department of Defense to standardize and upgrade their entire fleet of small, tactical, short-range recon drones across all military branches.
So instead of everyone using different systems, they want one reliable, certified platform.
One system. And the contract is designed to secure a qualified vendor for multi-year supply. And RedCat is rumored to be in a leading position for that award.
A decision on that could land in Q1 2026.
That's the speculation. Winning the SRRT2 contract would instantly provide substantial multi-year revenue. It would give them the long-term visibility that big institutional investors absolutely crave.
And beyond the big contracts, there's some corporate activity that signals the company's maturing, right? Getting ready for the big leagues.
Yes, the change in financial oversight is important. They engaged KPMG as their new accounting firm. That's a clear signal they're upgrading their governance, which is often a precursor to getting more attention from large funds and indexes.
And speaking of indexes, that can drive volume all by itself.
It can. Any potential ETF or index rebalancing usually happens in late January or early February. If the company gets included or has its weight adjusted, it can cause massive passive capital inflows.
Okay, this has been a really comprehensive look. To summarize for you, Red Cat Holdings presents this unique story. You have explosive revenue growth, a crucial certified tech mode, and it's all backed by an impressive cash cushion of over $200 million.
But 2026 is the year of execution. The whole narrative hinges on converting those ambitious margin targets, getting from 7% towards 20%, and of course securing those key defense contracts, with the rumored SRR T2 award looming over everything.
So what does this all mean for you, trying to integrate this knowledge? The current risks seem to be tied mostly to scaling and execution. Can they hit those 20 million plus Q4 targets, rather than survival? The cash on hand takes care of the survival part.
Right. The real question for you to consider is this. In this highly competitive race for defense autonomy, how much of Red Cat's current valuation is based on the proven product and the certified moat they already have? And how much is already baking in the speculative yet massive potential of winning that SRRT2 contract? That speculation is the ultimate factor here.
An important question to think about. That's all the time we have for today. Remember to subscribe and leave a comment if you found this useful. We'll see you next time on Smart Wealth with Joshua.